matter and says, gee, what happens if everything becomes worthless? Who would bear the onus of that liability, and then allocates basis to that person or corporation that would bear the onus? Non-recourse, generally based on profits, although it's actually a three-tiered method. All right, so we looked at chapter 6, and finally chapter 7. Okay, chapter 7 deals with contribution of services, or compensating the service partner. We talked about code section 707, where the person acts like a non-partner, a guaranteed payment, where the person acts where they want to make sure they get insured X dollars or X dollars every year, guaranteed payment, 707C. And then finally, just a plain vanilla distributive share. Right, so those are three general principles of how partners might be compensated, three different ways. But then we have partners who perform services, and they might be offered a so-called capital interest or profits interest, right? You recall? And capital interest generally, Albert, taxable or not, the receipt of capital interest? Taxable, right? And by way of contrast, in this case, is it profits interest, taxable or not? Non-taxable, right? Because look, there's an exception, right? Isn't that there's a revenue ruling or revenue procedure that makes clear that in extraordinary circumstances, a profits interest may be taxable, but in most cases, it will not be taxable. Okay, so you have that real juxtaposition between the receipt of a capital interest, again, taxable, the receipt of a profits interest, not taxable. Agreed? Okay. Not everyone's going to be able to memorize everything when you leave the course, but some of these general principles I'm hoping stays with you. So let's just get some foreshadowing, guys, of what's to come over the next several weeks. Chapter 8 deals with what we're going to look at tonight, transactions between partners and partnerships. Okay, partners and partnerships, because partners are going to engage in transactions between themselves and the partnership. What are going to be the tax consequences? They're also going to sell and exchange their interest. Now, note in chapter 9, I'll probably end class pointing this out, and this is important for exam purposes. There are some code sections that apply to the selling partner. There are some code sections that apply to the buying partner, okay? So when you're looking at chapter 8, guys, it's very important to label, are we talking about the buyer or are we talking about the seller, right? Everyone see that? You're halfway home if you can make that distinction, right? Halfway home. So everyone keep that in mind. Chapter 10 deals with operating distributions, okay? Partnership's been profitable. Now we're going to distribute assets. Generally, what do you think? Taxable or not taxable? You distribute assets. Generally not. It's not. Generally, just so you know, when we contributed assets into a partnership, taxable or not? Not taxable. Everyone agree? And when you distribute assets out of a partnership, we're going to learn generally not taxable. There are going to be exceptions. But I want to draw a contrast because some of you, maybe Viva, you're in the corporate arena. In the corporate arena, if you make distributions, taxable or not? Right, code section 311, it's one of those code sections you really got to keep in mind, right? That when a corporation distributes property, gains recognized, losses disallowed. Remember that? That's one of the most important code sections you guys can pick up in corporate tax. And when distributions are made, gains are recognized, losses disallowed. All right? So just bear that in mind that when we talk about operating distributions for your general principles, generally they're not taxable. But once again, if you look at chapter 10, you may want to circle, you may not. It's up to you. Look at the consequences to the recipient, namely the distributee, and then what are the consequences to the partnership, okay? So just like we're going to be doing in chapter 9, looking at the buyer and seller, chapter 10, we're going to be looking at the recipient versus the partnership. What are the consequences? So for exam purposes, make sure you apply the right code section to the right player. Helps, right guys? Chapter 11 deals with liquidating distributions. Just like in the corporate arena, there's different operating distributions in the corporate arena, code section 311. When it comes to liquidating distributions from a corporation, code section 331, 336 apply, okay? You're not responsible for anything in corporate tax. I think it's important that you see the contrast. Hey guys, just so you know, on WebEx, we can hear you. So if you could, you guys have to go on mute. Thank you. All right, so liquidating distributions, guys, what do you think? Taxable or not?
No.
Generally not.
No. Yeah.
All right, but that's the good news, Eva, right? Because the takeaway is generally why, going back to chapter 1, what's the takeaway? That when you start a business enterprise for most of your clients, what is the go-to entity, typically? Partnership or LLC, right? Because unlike a corporation, where generally you can be saddled with pretty tough tax events when you make distributions or liquidations, the same is not true of partnerships, right? So it makes it much more attractive, at least in my opinion. All right, so we will see how far we get, guys. I don't know beyond liquidating distributions. We may or may not get to chapter 12. So we'll probably get a little bit into chapter 12 with partnership liquidations, but I don't know how much further we'll get. So if we do get further, good for us. If we don't, that's okay. My job, in my opinion, is to go through the complete life cycle of a partnership. And we go from the formation to the operation to the liquidation, and some of these ancillary issues we don't get to. I don't want to rush just to say we got there. I want to make sure you guys, get there in a comfortable pace, okay? So that's at least a little bit of foreshadowing for the next several weeks, guys. All right? Anyone have any questions logistically or otherwise?
The final exam is cumulative, right?
The final exam is what?
It's everything.
It's cumulative, yes. That's cumulative, but obviously a much heavier emphasis on material that we're covering the second half, okay? Again, if you haven't, bear in mind, 2 of the 3 topics, Kevin, will be a week from Saturday on partnerships. So, October 26th, mark your calendar. You should come if you can to the tax event. Guys, we can hear you on the WebEx. All right, so you gotta go on mute. You know how?
You could mute them.
What was that?
You could mute everyone.
I can mute everyone. You guys have to teach me how to mute people. What do I do?
Yeah.
Like that?
Yeah, click on those. Yeah. You didn't do it for Leon. Yeah.
All right. Look at that. The power of the mouse. All right. Thank you. All right. Before we continue, anyone do anything interesting this past week? You're tired from tax season. All right. And so everyone here survived the 15th. No one had any wild parties on was it Tuesday was the 15th? Yes. So Tuesday you survived to make it to today. All right. So I guess what you're saying is, Eva, you didn't have any wild weekend. All right. Anyone do anything interesting? Like I said, guys, the 26th I gotta brighten up your days because You guys, don't sound like you're doing much outside the class.
Professor Solet, you might want to scroll down and confirm that the rest are muted as well.
Oh, there's more
There might be,
people?
yeah, it looks like you have more.
All right. Boy, we're gonna.
Yeah, Simone.
All right. Wow. Look at all those people. All right. So I think our operating distributions taxable if in excess of basis. It depends if you get cash in excess of basis. If you get cash in excess of basis, that will be taxable. Okay, that's going to be one of those events under Code Section 731. That will be taxable. If you get property, okay, in excess of basis, that will not be true. Okay, so we're gonna. That's a little bit of foreshadowing of what's to come. All right, Peter, we're not holding you accountable apparently for the noise. All right. Good news, we're not seeing Peter's back, or at least we didn't see Peter's back yet. I know he's going to flash his back as soon as I say that. But. All right. Any other questions, guys? All right, so here's the game plan. We're going to start, just so you know, for the exam, I'm not going to ask any questions, so we're going to do a pass on carried interest, because carried interest, in my opinion, that's going to be something that in 2021, something's got to give, something's got to change. I may be wrong, but so we're going to keep it on the simpler side with respect to giving equity interest to partners, and just keep it the way I said it. We're not going to get into issues that the authors raised about carried interest, so I hope no one's affronted by that, but we'll march on right to Chapter 8, okay? All right, so payments for the use of property. So these are property transactions between partners and partnerships. We have different code sections that could apply here, but you've been there, done that, right? We said before that the payments for the use of property that a partner supplies, and we're going to see this in some of the problems. You could be treated as a non-partner under Code Section 707A1, or depending on circumstances, it may, emphasis on the word may, look like a guaranteed payment, but let's hold off on that. The real thing that is of concern here, you want to open up the code. Let's look together at Code Section 707A2. So take a look, you could. 707A deals with partner not acting as in a capacity as a partner, okay? And you're going to be treated as a third party. Just for example, if you have a real estate partnership and one of the partners is an attorney, and the partner does all the real estate closings and is paid a fee, the partner is probably not acting in his capacity as a partner, okay? So they will be paid, and the partnership would treat them as if they were any other third-party contractor. But 707A, 2, capital letter A, and capital letter B. Look at these two. It says, treatment of payments for two partners for property or services. Okay? If you look at Cap A, treatment of certain services and transfers of property. If a partner performs services for a partnership, or, I have the word or circled, or transfers property to a partnership, there is a related direct or indirect allocation and distribution to such partner. And so all three of these conditions have to be met. The performance of such services and the allocation and distribution when viewed together properly characterizes a transaction occurring between the partnership and a partner acting other than his capacity as a member of the partnership. Such allocation and distribution shall be treated as a transaction described in paragraph 1. Okay, so if you connect all the dots, and the reality is the partner is supplying certain services or transferring property not in a partner capacity, but rather in a non-partner capacity, you will be thrust like chutes and ladders back to 707A1. And we're going to see an example of this. Similarly, in some instances, you look at 707A2B. If, notice the if again, the following 3 conditions are met, and all 3 conditions have to be met. They're conjunctive, right? You may want to circle the word and. There's a direct or indirect transfer of money or other property by a partner to a partnership. There's a related direct or indirect transfer of money or other property by the partnership to such partner. And the transfers, when described together, described in clauses 1 little I and 2 little I, when viewed together, are properly characterized as a sale or exchange. Guess what? It's going to be treated as a sale or exchange. So, what the code is doing here is Congress is sensitive to the fact that sometimes partners are going to try to camouflage their actions, because by camouflaging their actions, they can yield tax benefits. So the code is saying, no, not going to happen, or at least the code says it's not supposed to happen. It may happen, but it's not supposed to happen. All right? And how do you know that a partner is not acting as a partner? And what the authors point out on page 282 and 283 is if the partner has no risk or lacks risk associated with the performance of services or giving of the property, there's no risk, they must be paid. It doesn't look like they're part of the business venture, they look like an independent third party. And on page 283, they say other factors to consider are the transitory nature of the partner status and the proximity of time. So if you make a contribution of property and there's a quick allocation or distribution to you, well, that has much more of an aroma of it being a disguised payment. So the lack of risk, transitory nature of being a partner, and the proximity of time between giving the property or services and the receipt or distribution of partnership interest suggests that something funny is going on. Reba.
Okay, so first you mentioned that if he's acting as a not partner, then it will be not taxable to him?
Ma'am, I did not say that.
No, I'm asking.
If he's acting as a non-partner, then different tax consequences arise than if you're acting in your partnership capacity. Because just like we were saying, distributions to a partner are ordinarily not taxable, assuming you have sufficient outside basis, where payments made to a third party often constitute ordinary income. Okay? So this is a way for Congress just to ensure or try to send a message to the community that you can't try to use a partnership to manipulate tax outcomes, which in theory could be easy to do. Again, guaranteed payments, 707C. Do not worry about tax consequences under 199A. That takes this to a whole nother level. For my purposes, I'm not really worried. So let's look at the problem on page 284, because I think by looking at that, that gives us an illustration of just what you should be sensitive to. Now, I just remind people that whether it be in this class or in practice or any class in tax, guys, anytime you have a related party transaction, you've got to get your intent up. And related party here you guys might think, oh, it's a related party if it's a mother, daughter, son, father. There's got to be a real relationship. But keep in mind, anytime you're having a transaction with your own partnership, it's a potential related party transaction, right? So if the tax deal looks too good to be true, you may not, notwithstanding your creativity, you may not have been the first person to think of this creative idea, meaning Congress may have already put up an impediment. So let's look at problem on page 284. A, cash method, taxpayer is an equal partner in ABCD partnership. And when this is typical, right? The partner is cash method, the partnership is an accrual method, right? Very common. And what that means, typically, if you recall, under code section 267A2 and 267E, that in those circumstances, you can't accelerate a deduction and defer income. You can't accelerate a deduction and defer income. Why? Again, check out code section 267A2, code section 267E. A owns depreciable personal property, fair market value of $15,000, fair rental value of $1,000, which the partnership will use in its business. Before any of the transactions described below, the partnership has $10,000 in net income each year. So, let me just, A leases the property to the partnership for 3 years. The partnership will pay A $1,000 per year for 3 years for the use of the property. How might you think that should be taxable? Does that look like any hanky-pankies going on, guys? What's the hanky-panky there, Kevin?
This guy payment?
Well, why? He's getting $1,000 per year, which is the fair rental value, right?
But it would be because it's only for a short period of time.
I mean, maybe they only need it for 3 years. They talk about the partner being transitory. In other words, if the partner is only a partner for a year, that has an aroma of being potentially fishy. But the fact that they lease property for 3 years is not the transitory nature. He's in it for the next 10 years, who knows? So this is plain vanilla, guys. Okay, and Kevin, you're illustrating a point. Yes, your antenna should go up, but it doesn't mean that every transaction, and it's a fair statement, every transaction a partner engages with a partnership is problematic, okay? So you gotta strike a happy medium. You don't wanna go over the top, but you don't wanna ignore the fact that it could be problematic, right, Kevin? All right, so if this is plain vanilla, guys, this is a plain vanilla transaction, how are we gonna treat this for tax purposes? If you just had A is gonna treat this as a, just plain vanilla. David, you were gonna say, I think I overhear you?
A will get the ordinary income and the partnership, they will deduct you.
Is it ordinary or passive?
Oh, when you say it's ordinary income,
Okay.
okay? It is ordinary income. And it's not considered, if you look at, I think it's 469E, but don't quote me on that, it's not a passive income for, I gotta think about this. Interest, dividends, I don't know if rental income, I have to check if it would constitute passive income. But that's not our issue. Right now, the issue is the partnership for your notes can deduct $1,000. A has $1,000 of ordinary income, right? Because it's just like he's a third party leasing the property. What does that do to the taxable income of the partnership? Reduces it, right, from 10,000 down to 9,000. And assuming they're equal partners and there's no special allocations, each one would report $2,250, right? All right? Now, it's not designed to be the complicated issue.
Okay, so even though the rental fee is not paid in current year, it's still deductible. The reason is that it's a non-partner status. Is that right?
No. I think you're getting to question 2, or question B. Hold your thought. I mean, question B says, what happens if the rental payments are made on January 31st? So the partnership would like to accrue the deduction in year 1, right? But remember, under 267, it can't take a deduction until the payment is taken into income by the partner under 267. So I think, Ken, this is your question. In that case, the partnership would have 10,000 of income in year 1, and its income would only be reduced to 9,000 in year 2. Is that your question, Ken?
Not exactly. Even though the partner is a non-partnership status, since they are treated as a third-party transaction.
You mean for timing purposes?
Yeah.
You treat him like a partner, even though he's functioning in 707A
Okay.
category.
I see.
Okay?
Thank you.
I understand your question, but in this case, question B for your notes, the deduction would have to be deferred until January 31st, until the next year. Question C. A transfers the property to the partnership, which will use it for 3 years, and then transfer it back to A at the end of that time period. The partnership makes a special allocation of its first $1,000 of net income each year to A. Right? What result to A? Just makes a special allocation to A. Now, what the authors are pointing out here is there any risk to A in getting paid? Well, let me, your answers can go one, you could have 2 answers here, okay? Let me explain. If there's a risk that A may not get paid because, let's say, the partnership's income is volatile. Some years it makes money, some years it doesn't. Does A have risk? A has absolute risk, okay? And you can give him a special allocation of the first 1,000, and that may not be ordinary income, right? Because if he gets a special allocation and the partnership happens to have 40% capital gains, 60% ordinary income, that special allocation will double, right? 40% or $400 of capital gains, 600 of ordinary income. So if he's functioning and there's real risk and there's just a special allocation, then he's going to pick up whatever the character of the income of the partnership that the partnership earns. By contrast, if there's no risk, that there's some sort of guarantee that the partners or the partnership guarantees that he's going to get $1,000 come heck or high water, right? So he's going to get that, then he's not really functioning as a partner in a partnership, right? And that has the aroma of being a 707A1 payment, right, Ken? So in that situation, it would be $1,000 of ordinary income, right? Because it has a much stronger aroma of being some sort of guaranteed payment. So for your notes, I'm not trying to be ambiguous. You would want to know, is this payment, the first 1,000, is it definitely going to be made? Or is there a true risk that it might not be? If it's the latter, then it's just a normal partnership allocation.
Can be either of them.
It could be either. Now, the second part of the question says, what if instead the first $3,000 for the first year's net income and no subsequent income in excess of her 1/4 share is allocated to A? Who is this helping? If you give a special allocation to A of $3,000 year one,
The partnership,
and what do you mean by the partnership? Anyone in particular?
the other partners.
Right, B, C, and D, right? Because you're mitigating, right, their first year's worth of income, agreed? Because you're allocating that income to A, who's gonna have to take it into income anyway, but you're producing a better tax outcome for B, C, and D, agreed? So this would, Kevin, this is where your antenna goes up, and in all likelihood, 707 A2A would likely apply, okay? Where you have A2A, 707 A2A, a partner transfers property to a partnership, there is a direct allocation to such partner, and the allocation, when viewed together, is properly characterized as someone not acting in their capacity as a partner. And what would end up happening here is that this probably should be treated as all $3,000 of ordinary income to A, okay? So he would be taxed in year one on 52,250, and the other partners would be taxable on $2,250. In other words, what's going on here is that you take that $3,000 and they can amortize, the partnership could amortize that $3,000 payment over 3 years. So A would of course still have to, he would be paid $3,000, but he would also be allocated $2,250 in addition, right? He would be allocated $2,250 in year one, plus the $3,000 that he received. And then B, C, and D would be allocated $2,250, and in years 2 and 3, all 4 of them would be allocated $2,250, right? In years 2 and 3. Because you would amortize that $3,000 over that 3-year period. In year one, you would have $3,000 of ordinary income. They just front loaded the lease payments.
Can the partnership deduct all three?
No, it has to capitalize and amortize it over 3 years.
So it would be 1,000 per year, so
If you what?
1,000 per year.
A deduction of $1,000 per year. Okay? Page 285. You have sale exchanges of property between partners and partnerships. Now, I just remind people, some of you are in income tax right now, some of you it's a distant memory, but anytime you have a sale or exchange with a related party, first of all, losses could be disallowed because there's been 267. Right, everyone agree? Losses disallowed. Is there an analog in the partnership area? Yes, which is? Code section what? 70, let's look at it together. 707B1. Losses disallowed. No deduction shall be allowed in respect of losses from sale or exchanges of property, directly or indirectly, between a partnership and a person owning directly or indirectly more than 50% of the capital interest or profits interest in such partnership. Or when you have 2 or more that own directly or indirectly more than 50% of the capital interest or profits interest. Okay? So losses sometimes are disallowed, right? In a sale between related parties. Sometimes they're not disallowed. You guys remember? Isabel, I got to ask you. Do you remember if you have a sale with a related party, what is the character of that income? You sell something to a company that you own 60% of? Ordinary, what's your authority? And then Simi, see if you agree. Simi? 1239, right, Milla? Right. 1239, you guys remember? You sell to a related party, Code Section 1239 treats it as ordinary income where they would like to get capital gain treatment. Well, guess what? Code Section 707, B2. See, that's the beauty of tax, guys. There's repetition. Once you know one precept, it can apply in many, many different contexts. So 707, B2, gains treated as ordinary income. In the case of a sale or exchange directly or indirectly of property, which is in the hands of the transferee, it's property other than a capital asset, okay? Between a partnership and a person owning directly or indirectly more than 50% of the capital interest or profits interest in such partnership, or between two or more partnerships in which same sort of language we just saw. Any gain recognized shall be considered as ordinary income. So does this come up just like if you guys remember when I talked about the Code Section 1239? Does this kind of thing come up all the time, guys? No, right? And that's the problem. It doesn't. These kind of issues can come up once every 3 or 4 years, maybe even longer. But if you give the wrong information to your client because they say, gee, we're selling a capital asset or 1231 asset to our partnership, and we all want to be the hero. We want to say, oh, it's capital gain. Great, good news for your team. And you forget this, that's when life gets really kind of miserable. So, I'm just telling you, here's a landmine, right? Because the loss may be disallowed, or the character of the loss, right? The gain. I mean, on one hand, we're talking about losses. On the other hand, we're talking about gains. Losses disallowed, gains ordinary income. So Congress is very unnerved when partners have transactions with their own partnership, right? It's not a pretty picture. That's what the first and second paragraphs on page 285 after sales and exchanges deal with. Now, extending what I just said about the fact that when I was talking to Viva about some foreshadowing of what's to come, that generally partnership distributions are tax-free, right? And that's true whether they be both operational distributions and liquidating distributions. Now, of course, there's exceptions, but let's just take that as a general concept, right? That distribution is generally not taxable. Couldn't you concede, and when you contribute property, taxable or not taxable? Not taxable. So picture, if you will, Viva wants to be cagey with her partnership, so she contributes assets into a partnership that Kevin and I have been operating for years, and she contributes appreciated property worth $1 million, and she's depreciated the basis down to 0, right? So it has a potential gain of $1 million. Agreed? And Viva's been part of this partnership for years, the three of us have, and her basis in the partnership happens to be $3 million for outside basis. So she contributes this property worth $1 million, and lo and behold, a day or a week or a month later, the partnership makes a distribution to her of $1 million. Now, is that $1 million taxable to her? And the
Yes.
answer is, absent special code sections, no, right? Because she contributed property tax rate, look at that. Then move on, distribution, right? Tax-free, because generally distributions under code section 731 are tax-free. But we know, Viva knows, we can connect the dots. It's not arbitrary that, oh gee, she contributed a property worth $1 million, and a week later she gets a check from the partnership worth $1 million, right? Everyone agree that this didn't happen? We love you, Viva, but we're giving you the property, we're giving you $1 million because we needed that property, right? Alright, so, look. And by the way, if, for example, we didn't give Viva $1 million, Kevin and I said, you know what? We're gonna give her $750,000. The code and regulations make clear that's as if she contributed 1/4 of the property, but she sold 3/4 of the property. So you can't say, gee, you know, the property's worth $1 million. We'll just have a distribution of $900,000. I mean, no sane person would contribute $1 million to get back $900,000, right? Because so we can disguise our sale that way because it looks like there's no connection. No. In fact, the code and regulations go on to say there's a presumption that if there is a distribution within 2 years of the property contribution, that it's presumed to be a sale, barring extenuating circumstances, okay? So, for those who thought, gee, there must be a way around it, no easy way around it, okay? So, where is this all coming from? 707A2B. Um, 707A2, capital letter B, treatment of certain property transfers, and this is the kind of transaction I was just referring to, where these three conditions are met. It's going to be treated as a disguised sale. So this is a multi-factor test. Temporal proximity is a very important factor, spelled out on page 287. Then if you look at the second paragraph on page 287, there's other factors to consider as well. If you read that paragraph that delineates other factors, so it's not just the timing. There's other factors to consider as well. And then, just as I was saying to you on page 287, 288, it can be a partial sale. What happens if you take out liabilities on a property within 2 years of contributing this to property? And some of you may, again, I'm not testing, I just want to point out, because I think, at least for some of you, it's reassuring that some of these concepts keep coming back and back and back, but that's good because they're reinforcing. In the corporate realm, that many of you may recall, that when you contribute property subject to a liability, it's not considered boom. Okay, that's code section 357. Right? That when you contribute property to a corporation, that the corporation assumes your debt, it's not considered boom. What ends up happening under code section 358 is your outside basis gets reduced. But you guys may remember that if there is a tax avoidance motivation associated with that debt on the contributed property to the corporation, then that debt became boom, okay? And that could result in taxable income. Well, in the partnership area, guess what? Again, this is why these things are hopefully reinforcing that if you keep looking at this, that on page 288, 289, they talk about the fact that if you contribute property that's been leveraged in the past 2 years, and there's really not a business purpose for that leveraging, it's going to be presumed that that too might give rise to a potential deemed sale, okay? That might give rise to a deemed sale. So you have to be careful when you talk to people, clients, about contributing property subject to a liability. If you just looked at chapter 2 of our book, well, you'd be like, oh, not taxable. all right? Generally not taxable. But here, hey, if that debt was just recently taken out, that may be problematic. Right? And the same goes with, and by the way, just point out on page 289, there's all sorts of reporting requirements. So you can't just say, and none of us should ever say, oh, don't worry about this. The IRS will never catch wind of this. They could never discover this. There's all sorts of reporting requirements that you're supposed to fulfill to give the service a chance to discover the issues. All right. We talk about debt finance distributions. In other words, let me just, if you look at Canal Corp, I don't know if anyone saw this, or was able, this is a somewhat recent case. The important point of this case is you have a parent company, it was originally called Chia's Peak or whatever, but it was renamed to Canal. That's the main taxpayer. You owned an interest in this company called Wisco. And Georgia Pacific wanted Wisco. Georgia Pacific wanted the assets, at least, of Wisco. And what ends up happening here is that these two enterprises form a partnership. Wisco contributes all of its assets. I just drew a little. They formed this new partnership, and the new partnership borrows $750,000, $750 million worth of loans, and distributes it up to Canal. And the question was, and the only person responsible for the loans, essentially when you drill down, was Georgia Pacific. Okay? They were really on the hook for it. Albeit they dressed it up like Wisco was on the line, but that was all window dressing. Truth be told, it was GP that was really on the line for all this. And just so you know, how did the taxpayer get caught here? Because the IRS comes back and says this was really a sale by Canal of its Wisco assets to GP. Because what they were trying to do, Viva, was to treat this as a tax-free distribution. Once this money was borrowed at the partnership level, and given the basis, that the outside basis here, they try to treat the distribution as a tax-free return of basis. And the IRS said, no, this is a disguised sale. Classic case. And if you ever want to run into trouble, guys, you look on page 292. They filed a consolidated return. This is the third full paragraph. The taxpayer filed a consolidated return. In the Schedule M of the return, they reported a book gain but no corresponding tax gain. Anytime you start saying for book purposes, you have a gain, but for tax purposes you don't, you have a target on your back, okay? So just be forewarned that you have things are not gonna look good for you, particularly when apparently the taxpayer here, that my reading was, trying to find out where exactly I saw this, is that they made sure to tell the world that this was really a sale. I can't find the language I'm looking for. But anyway, on the bottom of page 292, the stakes here were not small. Respondent, which is the IRS here, issued taxpayer deficiency notice for 1999. The deficiency notice, respondent determined the joint venture to be a disguised sale that produced, look at this number, guys, it's $500 million, right, of capital gain, okay? The taxpayer filed a petition. The IRS asserted in an amended answer a $30 million accuracy-related penalty under Code Section 6662. And guess who prevailed in this case, guys? The IRS prevailed. It's going to be a bad day to call your malpractice carrier and say, you know what, the taxpayer got hit with a $30 million penalty here. So again, what's going on here? Why does this look problematic? Is because you're making contribution to a newly formed partnership right here. And in return of making that contribution, you get, I think the same day, they got $750 million. If it weren't the same day, it was very close thereafter. And if you look at the percentage interest, right, that they received, something smells in Denmark, where one partner contributes half the assets to the other, but still ends up with a 95% interest. And there's something that doesn't look right here. So the combination of the code section and the anti-abuse rules that we, time permitting, will look at. We're only getting an excerpt of this case, so we don't need to go into mega detail. The only thing I want to call to your attention again is the numbers here are pretty stunning, and it's just a word to the wise that if you're working on these large transactions and you're doing a lot of work to camouflage what otherwise might be taxable, just ask yourself the downside consequences. If the IRS comes back and says you're wrong, in this case, the accounting firm, law firm, whoever put this together, they may not have enough. It may not have enough liability insurance, and then theoretically your personal assets are at stake. All right. So, what do we as practitioners typically do? Here's some practical advice: put all your assets in your spouse's name. Okay. Very, very common technique. And if you want to know, this is a practice that was very common even in Roman times, that Romans put their assets in their spouse's name for professional liability purposes. Right? This is tried and true. All right? So you might consider doing it. Sometimes it gets a little funky because I had clients, both of which were OBGYNs and liability galore. So then you have to take other strategies because you never know which one's going to potentially be tapped. Anyway, I just point out on page 298, again, without getting into the mucky details of this case, is I just have lawsuits galore, because if you read that first paragraph under the note, this is not going to be, it's not going to end well for anyone, in my opinion. And the authors of our textbook point out GP has a real stake here because they negotiated. I am sure they said, gee, we're gonna reduce our purchase price because you're gonna have, less tax impact here. So part of the negotiations, I'm sure, where we'll go through this whole arrangement and we'll reduce the purchase price by $100 million because, you're not gonna get tagged for any tax. But there, I'm sure, and if I recall correctly, there was an indemnification that if there was any tax due, they would have to pony up, and I think they did actually have to pony up, like $100 million. So everyone here is pointing fingers. It's, what do they say, where you do, not roulette in a circle, where everyone's shooting at each other. Just don't know who's gonna get off the gun first. Anyway, so you have code section 707, with all these disguised transactions that you gotta be sensitive to. And then, on the bottom of page 298, they talk about, suppose you orchestrate it in a different way, instead of getting back cash, okay? Instead of getting back cash, the partnership changes its allocation, okay? Changes its allocations, just like we saw in the prior problem. If that's the case, if the partnership changes its allocations, then too, could be something disguised going on. And on page 299, the indented language talks about, in one little I, two little I, three little I, ways that taxpayers in the past have sought to camouflage their transactions. So, just, this is not for the faint of heart, is my message to you. All right, look at page 300. Let's go through some of these and make sure you guys can see the good, the bad, and the ugly. And Kevin, don't jump to any conclusions that if there is a transaction, it must be bad, okay? Just have your suspicions, be a skeptic, but don't just presume any transaction with a partnership is by definition a bad transaction. All right, partnership is owned 25% by A, his wife's father, an X corporation, which A is a 50% shareholder. What are the tax consequences of the parties involved in the following sales? Okay? So we got 25% by A, 25% by A's wife, 25% by A's wife's father, and X corporation owns 25%. And in this case, A is a 50% shareholder. During the year, the partnership sells A some land in which it has a basis of $50,000 for its fair market value of $40,000. Let's just stop there. What are the tax consequences? Partnership sells some land that has basis of 50, fair market value. What code sections might come into play? Say again? 267? Well, you're not going to see a partner or partnership. What's the better code section? Isn't it code section 707 B1? Right? Which talks about loss disallowance, but you have to have more than 50%, right? Everyone see that? And if you look at 707B3, you use the rules under 267C to determine ownership, right? So what percentage of this company or partnership is A deemed to own, guys? A definitely owns his own 25%, right? So we have 25%. How about A's wife?
Yes.
Yeah, if you look at 267C, a member of your family includes your spouse. How about your father-in-law? No, there's no double attribution. You don't attribute the father's share to his daughter and then from the daughter to the husband. That's a 0. And then, what percentage of X Corp?
12.5.
12.5%, okay? 12.5, that's under 267C1. So what is the 18 total? So what happens here, guys? Is the loss allowed or disallowed?
Disallowed.
The loss here is disallowed under what code section? 707 B1A. Code section 707 B1A. Now, I just want to tell you for your notes, what happens to your outside basis here? Okay, because the partnership does have a $10,000 economic loss. Everyone agree? The partnership lost $10,000 of economic value. Agreed? That loss is disallowed to it, but there is a loss. And what happens here is that the partners still must reduce their outside basis. I'll repeat, the partners must reduce their outside basis under 705A2A. 705A2A. Why? If you don't reduce the partner's outside basis, okay, they're going to get the loss. Even though the law says the loss is disallowed, if you don't reduce their outside basis, at some point, they're going to be getting a de facto loss, okay? So for your notes, I just call that to your attention that their outside basis will be reduced even if the loss is disallowed. If you want some more authority for that, you look at 267B-1B2, example 1, I'll repeat. 267B-1B2, example 1. Their outside basis must be reduced. Now, what happens if the partner subsequently sells the land to B for 45? In other words, what is A's basis in this property, guys? Say again, 40, right? On section 1012, cost basis 40. Everyone agree? And if he sells it for 45, must he report that $5,000 gain?
Yes.
No.
No?
Look at code section 707B1. Look at the flush language. In the case of the subsequent sale or exchange by a transferee described in this paragraph, code section 267D shall be applicable as if the loss were disallowed under 267A1. For purposes of code section 267A2, the long story short is the code is not here to penalize people necessarily. In other words, they're trying to stop collusion, right? Congress is. But if there's subsequently an event where you're selling it to a third party, that embedded law, in other words, there is a $5,000 gain, but there should have been a $10,000 allowable loss. Well, that never happened. So Congress is saying, look, we're not gonna penalize you here. We disallowed the loss. We're not gonna force you now to have the gain. So now, since you're selling it to a third party, that gain up to $10,000 would not have to be recognized. And that's spelled out too in code section 267. That if you sell to a related party, say a child, and then the child subsequently sells the property, whatever that loss that you forfeited, up to that amount would not have to be recognized as gain. So for your notes, no gain. Okay, question B. Same as A, except that the first sale is to a second partnership, also owned by the same parties, except that an unrelated party owns 25% interest, and X corporation owns no interest in the second partnership. In other words, A's wife, and A's wife's father own, I presume, 25% of both Partnership 1 and Partnership 2. And Partnership 1 sells to Partnership 2. Well, would that loss be allowed if you had identical ownership as to 75%, guys? What's your gut? Look at 707. B1B. Two partnerships in which the same persons here own 75% of the same interest. So that too would be disallowed, right? Which makes sense because you're really just selling it to your alter ego. How about question 1C? A sells depreciable equipment in which he has an adjusted basis of 20 with a partnership for 30. Seems innocuous. Depreciable equipment means it's a 1231 asset, right? What is the embedded gain here, guys?
10,000.
10,000, right? Everyone agree? Embedded gain of $10,000. And the person would like, let's just assume it's all 1231 gain. Well, how is that treated? 1231 gain or ordinary income under what code section? 707B2, just like 1239, right? Everybody agree? 707B2. How about A's wife sells residential rental property held by her as a capital asset, partnership for 120. She had a $100,000 basis. The partnership is in the housing rental business. So she sells residential renter property. It's kind of weird to hold it as a capital asset because to me, that's a 1231 asset. What percentage is she deemed to own, by the way, guys? What percentage?
62.5.
Isn't she deemed to own? Isn't she deemed, the wife here deemed to own, first of all, her own interest, right? She's owned her spouse's, she's owned her father's, right? And her husband's 50% interest can be reattributed to her. So her interest is 87.5%, right, guys? She's deemed to own her spouse's interest and her father's interest, right? And she's deemed to own her husband's corporate interest. There you can have double attribution. You can attribute the corporate interest first to her husband and then from her husband to her. So if she sells this property, okay, and the partnership's going to use it as a depreciable asset, well, it's not going to be a surprise. It's going to read 707B2A. It's going to treat it as ordinary income. E, same as D, except the partnership is in the real estate sales business. So now it's going to be treated as inventory, right? if you read the language, as long as it's not a capital asset in the hands of the partnership, Code section 707 B2A would treat it as ordinary income, right? You read the language. Any asset which is not a capital asset, right? So if your notes, again, ordinary income. What's clear, guys, again, is that for many practitioners, when they see a sale, of a capital asset or a 1231 asset, your natural inclination is to say, oh, capital gain, right? So you have to resist temptation, and your antenna really has to go up. Okay, problem 2. Although someone's asking, I think someone's asking a question here. I'm not sure. Okay. All right, question 2. Partnership. CD is owned 50% by C, 50% by D. If C sells an asset to CD and recognizes a $1,000 loss, will the loss be disallowed under 707B1? What do you guys think? Would the loss be disallowed or allowed?
Disallowed.
What's the threshold you have to be disallowed, guys?
More than.
Right? You have to have more than, right? Is this more than? No, it's equal to. All right? So in the first part of the problem, the loss would be allowed, right, guys? Everyone have that?
More than 50 or equal to 50?
There's more than 50, right? This is 50-50, right? So it doesn't apply here. Second part of the question, would it make a difference if C's father, F, sells an interest to CD and recognizes a $1,000 loss? So now we're having a non-partner who's related sell. And the authors direct us to that regulatory site. Everyone see that regulation? And that regulation produces a strange result. That regulation, if you had a chance to look, says look through the entity, look through the partnership. And it says requires that the sale be considered as if occurring between the father and C and D separately. So it's as if the regulation says the father is selling it to the partnership, but look through the entity, and then if the father sold an asset for a loss to his son, can he take the loss, guys? No, right? Code section 267. So as to the son, $500 of the loss would be disallowed. As to the non-son, the other partner, the loss would be allowed. So for your notes, based on this regulation, 500 disallowed, 500 allowed. All right, question 3. So that's kind of a strange, interesting result. A, cash method taxpayer is a 25% partner in ABCD partnership, has a $30,000 outside basis in her partnership interest, owns depreciable equipment, 1231 asset rate, and an adjusted basis of 1,000, fair market value of 20, right? Embedded gain of 19, and last we did our arithmetic here. Before any of the following transactions, the partnership has $60,000 in net income each year. What are the tax consequences in the following alternatives? A sells the equipment to the partnership for $20,000. A sells the equipment. Which makes sense, right? I have on my margins The adjusted basis, just to remind people, is 1. The fair market value is 20. Equipment. And A's outside basis, 30, right? How would you treat this, guys? We have to worry about 707 here. Does A own more than 50%, guys? No, right? So how are we going to treat this? Just 707A1, right? As if someone's selling it to a third party, right? So A would report how much? Guys, code section 1001, right?
19.
$19,000 gain, right? And the character would be 1231 gain. It's not going to be ordinary, right? Because it's the, right? What basis does the partnership have in the equipment? 20, right? A cost basis. So partnership now is a $20,000 cost basis, right?
Why is it not ordinary if A depreciated it?
But we don't know how much 1245 recapture there is or isn't.
Okay.
So it could be 1245, it could be 1231 gain, we don't know.
Okay.
Okay, the point is 707B does not apply to force it to be ordinary, right? This is not deemed to be a related party.
Okay.
Right? Question B. A contributes the equipment to the partnership. A is, okay, 721, right? A is not allocated any additional income, but her capital account is increased by the, value of the contributed property, right? That makes sense. Later in the year, A receives $20,000 distribution.
This guy is sale.
Right? If it, so what does it say again, B?
It's a disguised sale.
Right, because look, what is A trying to achieve? A contributes this property. What is A's basis? What happens to A's basis? Goes up by 1, right? 31. Everyone agree? Code section 723, her basis goes up by the value of the basis of the contributed property. All right? But, and then if she gets a distribution, that would be tax-free. But, everyone agree? That would be tax-free. But, so if this were truly a distribution, her basis would go down to 11. Okay? But what code section comes up to play? 707A2B. So in your notes, write that down. Code section 707A2B. It frustrates this result. We're going to treat it as a disguised sale. Why? The regulations say if there is a contribution of property within 2 years, there's a distribution, it's presumed that the two are related. What's my authority? Regulation 707-3C1. I'll repeat. 707-3C1. So what's the outcome here? Same as in A. This should be treated exactly as in problem A, right? Question C. Suppose the distribution is only of 15,000. happens then?
A prorated amount is the disguised sale.
Yeah, it's a pro rata sale, right? Part sale, part contribution. Part sale, part contribution. So, and the regulations under 707-3 F, example 1. 707-3 F, example 1. So it's going to be considered a sale, okay? Of we have 15,000. What's our basis in it? 750, right? Isn't that 3/4 of the 1,000 or outside basis? Or the basis of the contributed property? So there'd be a $14,250 gain, right? And then we're gonna contribute property worth fair market value of 250 adjusted basis. So there's a sale and there's a contribution. Okay, it's a two-part transaction. All right, everyone got that? That's what your answer to C should be like. Question D. Same as B, except that 1 month before the contribution, A borrows $15,000 on a recourse basis, securing the loan with equipment. In connection with A's contribution, the partnership assumes the $15,000 loan. Later in the year, A receives a distribution of $5,000. Okay, so A's getting $15,000 within 2 years. So that's going to be considered as if whatever liabilities A shed, that's going to be considered a sale. Okay, let's repeat that. Is that the loan is $15,000, right? And you recall from chapter 2, when A contributes the property, how much of that $15,000 is A shedding? Shedding 75%, right? Because he's a 1/4 partner, everyone agree? Isn't he shedding 75% of 15,000? So if you do the arithmetic, he's shedding $11,250, right? If you check me on that, and 75% of 15,000 is 11,250. What percentage of 20,000 is that? That's 56.25%, right? So it's deemed to be a sale of 56.25% of the property, right? Because that's the liability he's shedding. So it's as if the other partners bought out that percentage interest. So if you compute the gain there, his basis in that is $562.50. That's his adjusted basis. So the gain here would be $10,687.50. And then what happens when he gets the $5,000? Well, that's going to be considered as if he had another sale of 1/4 of the property, right? What's his basis in that? 250. So he's going to have another gain there of $4,750. And then what's going to happen with the remaining $3,750? That's going to be considered a contribution, and his adjusted basis there is $187.50. So this is a contribution. This is a sale, and this is a sale. Right, so again, let me summarize this. When he takes the loan out right before contributing the property, your antenna should go up, right? Now, the entirety of the loan is not considered an amount realized because he's only shedding 75%. He's a 1/4 partner. So that's why he's not deemed 15,000, only that portion which he's shedding. And that's his basis. We figured out that was his basis because that the sales price constitutes 56.25%. The second distribution is a VIVA kind of a distribution, right? VIVA, where you get the distribution and it's done within 2 years of making the property contribution. And then the third component is he's just contributing the balance of the property.
Not a good exam question.
Not a good exam question. I will say this kind of, excuse my language, crap happens though, where like, oh, it seems straightforward enough, and then it isn't. All right, so everyone got this on their notes on a rainy Wednesday night. Maybe you're not absorbing everything here yet, but maybe on a bright Saturday morning, double espresso in hand, this will make a lot more sense. Okay? I should point out, in fairness, we did see, a week ago, was it,
Deepak Chopra, yeah.
Deepak Chopra. Did anyone else ever see Deepak? How would you frame him as being what kind of person?
A
philosopher?
spiritual leader, yeah, spiritual leader. A doctor,
leader.
a doctor of alternative medicine and a spiritual leader.
All right, so no one else has ever seen him, but most of you are familiar. If you do a Google search, so Viva Soam got an autographed book, but Viva asked me, do I have any questions for this guru in life? So I asked if she could pose 2 questions. The first of the 2 questions, I don't know, you guys might have your own questions. My own questions were, how would he describe a perfect day? And what material thing could he not do without? Right? Are those 2 important questions you guys periodically ask yourselves? How would you describe your own personal perfect day? And is there anything material in your life that you couldn't do without? And after the break, we'll talk about the answer. But let's finish question E and F. Question E. A contributes the equipment to the partnership. The equipment is reflected on the books of the partnership at $1,000 adjusted basis. And A's capital account is increased only by $1,000. That's crazy, right? Who would contribute $20,000 to only have their capital account go up by $1,000? Something smells in Denmark, right? In order to ensure, which is kind of funny, Shakespeare got it wrong. Has anyone been to Denmark? The place smells great. Okay, a lot of Danish, right? And they have great Danish there, right? I at least in Copenhagen, everything smelled good to me. Anyway, in order to ensure that A is compensated for the full value of the equipment, the partnership allocates and distributes the first $19,000 of his income to A. The remaining $41,000 of partnership income is split equally by all 4 partners, so that A is allocated a total of $29,250 of the partnership income, and the remaining partners are allocated $10,250. Is this problematic, guys? Yeah, this is problematic. This is what 707A2A 707A2A says is problematic, where this is going to be treated as a sale. Okay, this is not going to fly. For your notes, this is going to be treated as the same as in A, right? That this is a disguised sale, and the results are the same as in problem A.
It should not be guaranteed payment because he's
All right, just say it loudly, Viva.
he's getting a guaranteed payment.
So, but again, this is all the aroma. of being a fixed, assuming the partnership can really produce this income and there's really no risk that he will not receive this, this is truly a disguised sale. You can't camouflage it by using allocations and manipulating your capital accounts to produce an outcome. Okay, but they're trying to avoid capitalizing the property and then having to take depreciation deductions. Question F, final question, then we'll take a break. Suppose the partnership does not need the equipment in its business, but A nevertheless transfers it to the partnership. Partner B transfers similar depreciable property and $2,000 cash to the partnership. 2 months later, guess what? ABC partnership distributes A's old property to B and B's old property together for $2,000 to A. So what does it look like?
It looks like B and A exchange property.
Right, B and A, this is gonna be treated as a sale between the two, A and B. This is 707 A2B.
So it's a sale, not like an
It's gonna be
equivalent.
treated as a sale to A. For A's gonna have to recognize 19,000, and B's gonna have to recognize 14,000. In the old days, you might say 1031 applied, like-kind exchange, maybe, but 1031 in the year 2019 only applies to real estate. It no longer applies to equipment, so it cannot qualify for Code Section 1031 treatment. All right, so here's the gig, guys. When we come back, let's come back in about 8-9 minutes, and if you don't mind, you're gonna learn people's names. You know, you might laugh at me about the 10 cards and say, hey, why do we need these? First of all, it helps me, but I need people who will line up around 7:50 outside, alphabetical, my last name, so I can distribute your exams and then we'll go through them, okay? So does that sound like a plan, guys? All right, so introduce yourself. A's are gonna be in the front, Z's in the back. Sorry, Z's.
You're talking just first name basis, right?
Like, say it?
Just first name.
Last name.
Last names.
Last thing.
Last names, okay? So grab a coffee.